Welcome to Iron Financial. Our job here is simple. We forge stronger portfolios by smashing through all the market noise. And today we're taking T-Mobile's latest earnings report and we're putting it right on the anvil. We're going to hammer it, test every single weak point, and find out if this thing is built from solid steel or if it's about to shatter under pressure. Forget the hype. This is a full-blown structural analysis. Let's get into it.
Okay, let's get one thing straight right from the jump. The telecom world, it's not some friendly club. It's a brutal, knockdown, drag-out fight for every last customer. I mean, these companies are in a constant war for market share. So when T-Mobile rolls out with these huge, flashy growth numbers, every single investor has to ask themselves one critical question. Are they actually building a fortress that can withstand a siege? Or is this just a pretty facade built on the shifting sands of promotions and expensive acquisitions? Is this strength real and sustainable, or is it just a temporary sugar rush? That's what we're here to figure out. And that is exactly the right question to be asking. To get an answer, we have to start where any major construction project begins, with the foundation. In the world of telecom, that foundation is your customer base. Simple as that. You can have the best network, you can have the cleanest balance sheet in the world, but if you don't have a growing, loyal customer base, you've got nothing. So, for the first part of our stress test, we're inspecting that foundation. Are they winning the ground war for subscribers? Let's dig into the raw numbers.
Okay, let's get right into the raw data. We're starting with postpaid net accounts. Now, for anyone new to this, these are the absolute crown jewels in the telecom industry. We're talking multi-line family plans, we're talking small business accounts. These things represent stable, high-value, recurring revenue. Why? Because they have lower churn and a much higher lifetime value. So in the fourth quarter of 2025 alone, T-Mobile added a massive 261,000 of these accounts. That is not just a good number, it's an industry-leading figure. It shows they are absolutely dominating the war for the most profitable customers out there. It's the first heavy blow and what looks like a very powerful 1-2 punch.
And here comes the right cross that follows that jab. We're going to drill down from the accounts to the individual phone lines. In that very same quarter, they added an incredible 962,000 postpaid phone net customers. Now, to put that number into perspective for you, that's like adding the entire population of a city like Austin, Texas to their most valuable subscriber list in just 90 days. This is a massive signal that their network, their pricing, their whole value proposition, it's resonating deeply with the market. This isn't just growth. This is aggressive, relentless market share capture.
And here is the knockout punch of this round. When you add everything up, the phones, the watches, the tablets, all those high-margin postpaid connections, the grand total for Q4 comes to 2.4 million net customer additions. Let me say that again, 2.4 million. In a single quarter. This is the kind of number that makes executives over at AT&T and Verizon break out in a cold sweat. It's a pure statement of dominance in the core battleground of this entire industry.
And this slide, well, it illustrates the full picture perfectly. Just look at this. This comes from their own report. It's not just one metric lighting up. It's a clean sweep across the board. Postpaid accounts, postpaid phones, total customers, broadband. Every single one is pointing up and to the right, and they've all got that little tag, industry leading. What you are witnessing here is market gravity in action. They are literally pulling customers in from every direction, from all of their competitors. This, on paper, is what a rock-solid foundation looks like. The concrete is being poured, and man, it looks solid.
Whoa, hold on a second. Let's not get mesmerized by their own highlight reel here. I pulled this quote directly from their investor fact book. You see that? Higher account deactivations, higher industry switching. They're literally telling us in black and white that while they're shoving new customers in the front door, the back door is swinging wide open. So the real question is, what's going on here? How much of this growth is just a revolving door of customers? How much of it is just driven by those expensive, low-margin promos or big acquisitions like UScellular that just make the numbers look good? Are these loyal, long-term customers, or are they just renting them for a quarter until a better deal comes along? To me, this looks like a potential crack in that foundation before the concrete even has a chance to set.
That's a fair challenge. A foundation of customers, no matter how big, is completely worthless if you can't monetize it. It's just a concrete slab sitting there. You need to build a profitable structure on top of it. So let's move to the second part of our stress test. Let's examine the steel beams of this operation, the core financial metrics. We're talking revenue, profit, cash flow. This is where we separate the real contenders from the pretenders. Does all that customer growth actually translate into real financial muscle? Let's start right at the top line.
Service revenue. This is the money they make from their core business, from subscriptions. In the fourth quarter, it hit $18.7 billion. Now that's up a staggering 10% from the year before. In an industry as mature as telecom, double-digit revenue growth is practically unheard of. This is undeniable proof that those 2.4 million new customers aren't just empty stats on a page. They are paying customers and they are adding serious, heavy-duty revenue to the top line. This is the first steel beam of the structure, and it looks incredibly strong.
You know, they say revenue is vanity, but profit is sanity. And what's really interesting here is the story this slide tells about their profitability. So while that revenue was soaring up, their GAAP net income, the actual bottom line profit, took a nosedive. It dropped from nearly $3 billion in Q4 of 24 all the way down to just $2.1 billion in Q4 of 25. So wait, they're adding all these customers, they're growing revenue, but they're actually less profitable? Where's all the money going? Is the cost of getting those customers so high that it's eating away at the entire structure? This looks less like a steel beam and more like a potential stress fracture.
Context here is absolutely critical. You can't just look at that headline number and panic. That drop in net income, it wasn't because of operational weakness. It was a planned strategic move. They executed what they called a workforce transformation, which, as we all know, is corporate speak for layoffs and restructuring. That came with a one-time charge of almost $300 million that hit the books in Q4. So this wasn't a crack in the foundation. This was a deliberate cost to reinforce the entire structure for the long term, cutting costs now to improve profitability down the road. You have to look past these one-time hits to see the real picture.
And hey, if you need proof of that, just look right here. Once you adjust for those one-time costs, the whole story flips on its head. Wall Street analysts, the folks who get paid to model this stuff down to the penny, they expected T-Mobile to post adjusted earnings per share of $2.04. T-Mobile didn't just meet that expectation, they completely crushed it, delivering $2.14. What this tells you is that they are out-executing and outperforming expectations. The core earnings power of this business isn't just intact, it's actually exceeding what the market thought was possible.
Okay, so let's pivot to what I consider an even truer measure of a company's operational health: core adjusted EBITDA. This metric, it strips out a lot of the accounting noise and gets us closer to the raw cash-generating power of the business. And here, we see solid, powerful growth. It grew 7% year over year to $8.4 billion for the quarter. 7% growth on a number that massive is some serious heavy lifting. It shows the core engine of this business is firing on all cylinders, and it's getting stronger.
Okay, fine. You can talk about EBITDA all day long, but I'm going to raise you the one metric that actually matters to investors: adjusted free cash flow. We're talking about the cold, hard cash left over after everything is paid for. This is the money for paying down debt, for buying back stock, for rewarding shareholders with dividends. And you know what's happening here? Growth is slowing to an absolute crawl. We're talking just 2% year over year. So you have to ask yourself, if this business is so strong, why isn't it spinning off more cash? 2%? That's not just slow, that's anemic. It's a huge red flag that tells me the cost of all this growth, all the capital spending, might be starting to weigh this whole structure down. I mean, you can't build a skyscraper if you're running out of cash to buy the rivets, right?
That's a valid point. Cash flow is king, no doubt about it. But a snapshot of a single quarter doesn't tell the whole story. While the current performance is solid, the real test of any major construction project is its blueprint for the future. You have to ask, are they building for next quarter, or are they building for the next decade? So let's move on and examine the architectural plans, the company's guidance, and their blueprint for what they plan to build from here. Now this is the blueprint. Just look at the service revenue trajectory. It's a clear, powerful staircase of growth. You go from $66 billion in 2024 to over $71 billion in 2025. But the real key is what's coming next. They're guiding for roughly $77 billion in 2026, and then smashing through the $80 billion barrier in 2027. This isn't just some wishful thinking. This is a detailed plan they've laid out for all of us to see. They are showing you, step by step, exactly how they intend to continue their ascent and cement their dominance in the market. This is a blueprint for a much, much larger fortress. A blueprint is only as good as the materials you use to build it. So let's actually dissect that impressive 2026 forecast. They're projecting about 8% growth on the top line. But when you really look under the hood, you see that a huge chunk of that growth, about 45%, isn't organic. It's not them winning more customers in the marketplace. It's them going out and writing checks. Now look, that's not building a fortress. That's just buying a collection of prefabricated walls and hoping they fit together. A strategy that relies this much on M&A is just full of risk. You can overpay for stuff, you can struggle to integrate everything, you can take on mountains of debt. So, is this really a blueprint for building, or is it just a blueprint for buying? And hey, don't just take my word for it. This is straight from their own executive on their earnings call. They are telling you loud and clear that their growth story depends heavily on acquisitions. $3.6 billion in 2026, another $4 billion in 2027. This brings up a really fundamental question about the entire structure we're analyzing. What happens when the acquisitions stop? What happens when they run out of companies to buy? Or maybe the regulators step in and say, no more. Is the core organic business strong enough to carry this structure all on its own? Or is this whole thing just being propped up by these M&A stilts? You're absolutely right to question where that growth is coming from. A heavy reliance on M&A is a risk, and it has to be weighed. It's a key variable in this whole stress test. So we've examined the foundation, we've tested the steel beams, and we've scrutinized the blueprint. Now it is time to step back, weigh all of the evidence, and render our final verdict. All right, let's summarize the bull case. The evidence for T-Mobile being a financial fortress is frankly overwhelming. First, the foundation is solid rock. They have dominant, industry-leading customer growth, pulling in 2.4 million postpaid net adds in just one quarter. Second, the financial structure itself is incredibly powerful. 10% service revenue growth and 7% core EBITDA growth shows they are monetizing that customer base very effectively. Third, they consistently execute better than the market expects, absolutely crushing adjusted EPS estimates. And finally, they have a clear, ambitious blueprint for continued growth toward $81 billion in revenue. This is a picture of a company firing on all cylinders, building an empire. But even a strongest fortress can have weaknesses. Let's lay out the bear case, the potential cracks in the armor. First, their bottom line GAAP profit is down year over year. You simply can't ignore that. Second, the growth in free cash flow, which is the lifeblood of any business, has slowed to a very worrying 2%. Third, as we just talked about, that future growth blueprint is heavily dependent on them buying growth, not just earning it. And finally, their very own documents admit to rising customer churn in what is a fiercely competitive market. Look, these are not trivial concerns. These are the kinds of hairline fractures that, if put under the right pressure, could threaten the integrity of the entire structure. So, the evidence is on the scales. On one side, you have a powerful fortress of growth. On the other, the real risk of hidden cracks. We've put this company on the iron financial anvil, and we have hammered it from every possible angle. Now it's time for the final judgment. Is T-Mobile an opportunity to forge wealth, or is it a trap just waiting to snap shut on your portfolio? Here is our verdict. The risks that you've pointed out are valid, and they absolutely must be monitored. That slowing free cash flow and the reliance on M&A are not insignificant. We call them hairline, surface-level cracks. However, the overwhelming evidence from our stress test points to a core structure that is forged from solid steel. The sheer force of their customer acquisition engine, combined with that powerful top-line revenue and core EBITDA growth, provides a level of durability that, in our view, outweighs the risks. They are successfully navigating this brutal telecom battlefield, and their operational momentum appears strong enough to patch those cracks and continue building higher.
So, the structure stands strong under today's stress test. But we're going to leave you with this one final thought. The telecom war never, ever ends. Your competitors are constantly rearming, regulators are always watching, and technology is relentlessly changing the entire landscape. So you have to ask, is any fortress, no matter how well built it is today, truly safe forever? That's the question you have to answer for your own portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.